Hello, everyone. Welcome to today's call for the Subsea 7 Saipem merger discussion. Thanks, everyone, for joining. Before we really kick anything off, I just have a quick disclosure I need to read, which is just that Robotti and Company and its affiliates do own positions in some of the companies discussed today. This presentation is for information purposes only and should not be construed as investment advice or a solicitation to invest. Past performance is not indicative of future results. Investing involves risks, including loss of capital. The other thing I wanted to mention to everyone is that there will be a Q&A section at the end of this call. So as we're going through the presentation, if you have questions that arise, please feel free to use the Q&A feature in the Zoom to submit your question. We'll try and get to as many of them as we can at the end of the call. But don't worry, if we don't answer it, we'll make sure to reach out to you afterwards and get you the answer to your question. So the way that we're going to structure today's call is Bob's going to go through the offshore industry as a whole to provide a little bit of context for how we've gotten to where we are today. He'll then talk about our involvement both in the firm and in the company and in the industry overall. Then we'll go into how this merger is a transformational merger, both for Subsea 7, Saipem, and the industry. And finally, he'll go into some of the nuts and bolts of the specifics of the merger. So before I hand it off to Bob, I just wanted to give a quick overview of our firm. We've been in business for over 4 decades, and in short, Ben Graham is still the man. So what I mean by that is that we employ a Ben Graham style investing. And so what we're looking for is the discounted future cash flows of a business, and we try and find a way that we can buy that at a discount. And we do this with an extensive research team and decades of experience. And we primarily focus on small and mid-cap companies where we think we can not only add the most value, but it's where we think we can find value. And another space that we really like to hunt in is cyclical industries. And these are areas that even self-proclaimed contrarian investors often shy away from. But these ugly duckling type forgotten companies are often where we have found some of the best opportunities. And so what we're going to do today is we're going to walk through one of those opportunities playing out in real time. And so with that, I'll hand it off to Bob. Bob?
Thank you, Theo. And thank you all for joining the call today. I hope it's informative. Let's start off with here's a picture, a graphic that kind of shows a lot of the businesses that Subsea 7 and Saipem are in and what they do. And the critical part of the business, the largest component is offshore SURF. And SURF is an acronym for subsea umbilicals, risers, and flow lines. So those are the things they install in deep water to develop new oil and gas fields. And then there's conventional, which is, again, pipeline lay in deep water and shallow water for extensive amount. In addition to that business, which will be the Subsea 7 subsidiary of the new Saipem 7, the offshore wind is a significant part of the business of both companies. And that's what they do. But there's also a number of other things in the Saipem portfolio, as well as in Exodus, a subsidiary of Subsea 7, that is doing things with carbon capture and sequestration. Subsea 7's been on a project for a number of years called Northern Lights that recently has expanded dramatically. It also is involved with floating wind. There's a number of hydrogen technologies and uses that are being investigated. So there's a number of new energy, renewable energy things that they have exposure to that potentially can, over time, have the opportunity to become significant. So it's important to have an understanding of the historical context. And so this is an industry we think that has developed to where it is today. That's really interesting, over 40 years. And we've circled the items. Our involvement was from the mid-90s with Stolt Comex, eventually became Stolt Offshore. It eventually became Acergy, and in 2010, we became shareholders in Subsea 7 through the merger. A significant item business I want to point out is DSND Offshore, which was originally controlled by Christian Sam. He bought out the Halliburton business, and therefore created Subsea 7, which in 2010 merged together with Acergy, and those are the number 3 and 4 market participants at the time, and they became the number 1 participant. And that's a critical aspect, is the involvement of Christian Sam, because what we do like to do is invest in companies where there's an owner-manager that really is controlling the opportunity. So in cyclical businesses, we found really smart operators who are aligned with shareholders, do things strategically, logically, to therefore substantially improve the position and the earnings power of the business that we're invested in. And Christian has done that repeatedly. And in all of these transactions, as he's made a much larger company, adding 1 and 1 making 3. In each of those situations, he's gone from owning a significant interest to reducing it dramatically. And yet the offset clearly in his mind is that he's getting more in return than what he's doing to reduce his interest. So he went from originally 44% of Subsea 7 on its merger with ACG, became a 22% shareholder. Over time, grew that to 25%. And in the combination here with Saipem, will end up as a 12% shareholder in the combined company. And therefore, we think that he's making a value qualitative decision every time he's agreeing to these mergers. What I'm getting in return is substantially more than what I'm giving up. And yet he still is a significant shareholder. He'll be the chairman of the company. And so therefore, kind of his vision of having, and he's been the architect of putting this company where it is today and in executing this transaction. And so that's really a critical element in understanding and the appreciation for that. What this also does highlight is in these cyclical businesses, we regularly talk about Schumpeter's process, and that is when things do well, new capital comes in, and then in the cycle, when it goes down, people leave, consolidate, and there's repeated patterns that some of the combinations here are Christensen with the company he's controlled, opportunistically growing, taking advantage, buying assets at a time when they're cycled out of cycle and of less interest. And so here is a snapshot of part of that more recently. So 2014 was the previous peak cycle. And what happened in that year was a significant reduction in the amount of new awards. And that was not based on the price of oil, because at the time, oil was $120 a barrel. It was based on the fact that the cost to develop these fields made them uneconomic, even at $120 oil. And so therefore, the industry had to revisit what they did, how they did things, therefore substantially reduce the cost of it. Of course, what also happened in the end of 2014 is when OPEC decided to take back market share and substantially reduce the price of oil. So for 5 years, this industry was in an extremely difficult situation. And that's what happens at the down part of the cycle. Many people left the business, other people were consolidated. So the industry structure radically changed. And that's what you had. Industry consolidation, fewer global leaders, reduced competition. In addition, this is a little bit busy chart, but it helps to understand the adjacencies that are critical to the business. And that is, and you also do see a lot of market attrition going on here, if you can kind of see the detail, which you probably can't. But an important transaction was almost 10 years ago, Technip and FMC merged. And FMC is the subsea equipment end of this business. And Technip was the installation company that does the engineering, installation, design, similar to Subsea 7. The combination of those two companies then said, we have a service offering where we have a fully integrated service offering that we can differentiate what value we can bring to you and help you reduce the cost, and therefore dramatically increase the likelihood that you've got a field that can be economically developed. Underneath, there's the number of the competitors that went away through the 10-year down cycle that happened here. A number of those were companies that Subsea 7 opportunistically acquired assets, businesses from at very depressed prices, therefore increasing its earnings power of the business, as we repeatedly see in these cyclical businesses run by owner-operators. And one of the more recent things that has happened is in the equipment side of the business. Historically, there were 3 large competitors: FMC, who's part of Technip today, but the other one was Aker Solutions and OneSubsea. OneSubsea is a subsidiary of Schlumberger. And so 2 years ago, 22, completed in 23, was the combination of the OneSubsea business, who is the number 2 competitor, with the Aker Solutions business, who is the number 3 competitor, therefore making the largest installed base of subsea equipment, larger than FMC's. And that's also critical because that is a related party that Subsea 7 regularly does business with. In the process, Subsea 7 also acquired a 10% interest in that equipment business that is frequently partnered with Subsea 7. Now, what we said was in 2014, the business fell off dramatically because the cost had gotten so high. Many of the fields were uneconomic. Many of those fields that had been discovered that were candidates back in 2014 are still the candidates that in the last few years, projects have been sanctioned, they've moved ahead. And why is that? Because the cost to develop these fields has radically been changed. And it's not just service delivery costs have gone down, it's much more structural than that. There's because of the combination of Technip and FMC, and then the closely followed combination of Schlumberger's business with Subsea 7, the ability to kind of design these projects holistically and really put in things like standardization. And so therefore, instead of making every project design for its own, and therefore all kinds of inefficiencies built into the process, but also technologies that each of them had developed that were proprietary that enabled longer tiebacks to be economic and therefore substantially increase the likelihood of discovery could be economically produced, and in the process dramatically reduce the cost to develop offshore fields. So today, 60% of those fields that have been identified are probably economic at $30 to $40 oil. So therefore, even the current depressed oil prices is not putting at risk the sanctioning of these projects. So, and the industry structure and what Technip and FMC and Subsea 7, along with Schlumberger, has done is substantially changed and reduced the cost to develop these fields, and therefore increase the opportunity set for the entire industry. And that's been an important aspect of where we are in the cycle. Now, in addition to the internal structure and the cathartic process we talk about in difficult times, how things scale back, consolidate, and competitors who are differentiated with service offerings, rise to the top and therefore provide incremental service and then incremental return and profitability to them. You also have had, and that's driven, of course, these fields are now economic. So here is the pipeline of projects that we saw back in 2022. Many of these projects have now been awarded, and that's what you see these companies, the three major companies, Technip, FMC, Saipem, Subsea 7, have record backlogs. So the activity level has ramped up because the economics have improved and the projects are economic and how are proceeding. But here, what we're looking for is also how this moves over time. This is the most recent map that shows. So on the backdrop of the highest backlog already sanctioned and awarded is a pipeline of new projects that will likely be sanctioned in the next 2 years. And you see there's many more projects, but you also see the color coding is significant. It's probably hard to read, but what it really is the high end of the range is much larger dollars than there were because the scope and scale of these projects have dramatically increased. And so therefore the opportunity set for the business has grown. What we'd also point out here is that frequently, of course, offshore energy is considered the price of oil. It always dominates the conversation. A significant amount of the projects here are also the development of offshore gas projects. And so gas is a key component, and gas is two markets. There's the domestic market, which those projects proceed no matter what happens to the price of the commodity, because what it does is it enables a country to produce resources for itself and displace the purchase of oil or gas from somebody else. So Middle East projects, actually Sakarya is a project in Turkey, which is the best example that's fast-tracked that project and substantially changed the purchasing pattern of Turkey and enable them to supply much of their own energy needs with their own production. Those projects continue to go ahead without regard. So that adds stability to the business. But what this also does is, since these projects frequently are 3 years in timeline, with most of the work done in the last year, the visibility of activity offshore, we think, is demonstrable. And we also see the likelihood of continuing increases in contract awards and therefore demand and activity. And so a positive backdrop, we think, for all offshore energy services that you can see from these projects, the backlog, and the order pipeline. Now, let's get to where we are now, and that's the combination between Saipem and Subsea 7, who are two of the three largest providers in the SURF and conventional installation business for offshore fields. So each of these indicates the strength of each of these companies in these particular sub-segment markets. So SURF, Subsea 7 is the preeminent company in that business. In the conventional business, Saipem is maybe the largest competitor, and the same thing, Trunkline, they have a very big position. But these complementary services substantially improve the capabilities, the service offerings, the ability to execute, the reduction in costs, the capacity that can be used. So many positives come to both the combined company, but also the industry benefits from as well. What we'd also point out again is this SIA, right? That's the Subsea integrated alliance with Schlumberger. And we do think that that is, again, part of this technology change. Early intervention, designs, technology, and by being able to offer the full suite of services, both the equipment, the procurement, the installation, is a differentiator that both Technip and Subsea 7 Schlumberger do have. Of course, the Subsea Alliance will be strengthened by the fact that the relationship is now dramatically increased. So not only is it Subsea 7 that will be partnering with them, the full vessel fleet of Saipem will be available to work with Schlumberger and this integrated alliance. In addition, there are other lines of business that Saipem is in that Subsea 7 is not. And so we think some of these probably are candidates for divestiture over time. Others we think are really interesting and do tie into both the traditional business of the conventional and surf, as well as some of the new technology and new energy things that Subsea 7 is already involved with, and we think have really interesting growth opportunities to them. So here's where you this is where the rubber meets the road. So that's what it is Subsea 7 has and Saipem have identified themselves as asset-heavy companies. And that's in contrast to Technip FMC, who's for a long time said, we're an asset-light company. We don't want to own vessels. We charter in vessels. That's part of the equation and delivery service. But therefore, that means we don't have to put capital into owning those assets. Subsea 7 has always had a differentiated point of view, and that is those assets are the thing that puts you in business, and you need to have those assets. And so there's always been an asset-long approach to Subsea 7. Now, in the last 10 years, when the business was in downturn, that caused some issues, but not really, because the entire time Subsea 7's balance sheet was pretty much no net debt. So therefore, they had a clean, debt-free balance sheet, in spite of the fact that it was theoretically asset intensive, and yet they renewed the fleet in that 10-year period, all for money internally generated without borrowing extra money, and therefore never went into debt. So it isn't nearly as asset heavy as kind of people perceive it to be. But to own the assets, especially today, what's happened is the activity level has dramatically ramped up. The availability of equipment is becoming tighter and tighter, and that's reflected in pricing for the industry and profitability. And it also is reflected in who can provide services. And again, it's can you get the job? Will you be able to deliver on the job? What's the pricing? What's the profitability? And the profitability continues to improve over time. As people talk about their aged backlog, and the older the backlog, the lower the margins. And as it migrates to more recent contracts, the margins continue to expand. And even now, the projects continue to expand. For example, Saipem has said all our vessel fleet is contracted for the next 2 years. And they recently, 2 of the vessels on this chart, they recently chartered in to therefore increase their capacity to give them ability to continue to bid on business. So the integration of these businesses and these assets are critical. So as you can imagine, these are spread throughout the world. And part of the process is the key enabling assets will need to work in a contract in a different geography. And therefore, it will need to transit from West Africa to Brazil, from there to the North Sea, to North America. And in transit, right, the asset isn't working. So their key assets go through frequent portions when they're transiting and therefore unable to work. So the geographic concentration is such that they probably have substantially less time when they need to be moving and relocating the vessels. So therefore, capacity utilization should dramatically improve. That means profitability should improve. That in addition to not only the geographic spread of the assets, there's also the capability. So, on here it says things like rigid reeling, S-lay, J-lay, flex-lay. These are different vessels that do different things and have certain capabilities, and you can use them for other purposes. But if you're underutilizing the asset, that's suboptimal. So the larger the fleet, the better the opportunity to match the asset to the project that it can provide the best service. It can do that in the shortest amount of time. It can be most cost effective. So there's many advantages that comes from having a fleet of the size of these 2 companies, and therefore optimizing and maximizing the use of the fleet is a real synergy. And of course, the company has talked about $300 million of cost synergies, but the real opportunity here is in maximization of the fleet in terms of its utilization, day rates, and reducing the cost as it optimally functions in its best mode. So the same thing is true in the offshore wind business. Both companies are in the offshore wind business. Subsea 7 has a full complement of services there, as opposed to Saipem's is more selective in a few of the lines of business. But again, once again, the two of them line up. And this also reminds me that over time, Saipem and Subsea 7 regularly will have vessels from one fleet or the other working on either joint venturing on a contract or subcontracted out to the other. And so therefore there already is a working relationship between them where assets have moved back and forth on a contract basis between them. So therefore we think that also is a real positive in terms of the facilitation of the smoothness of the integration of these two businesses. So offshore wind 3 years ago was in the doldrums. Pricing had been very difficult. People weren't realistic with the time, effort, and cost associated with the projects. And a lot of the projects lost money. That's corrected its process. So Subsea 7 and Saipem both stepped back, revisited, and are much more selective in how they bid on things and have a much more informed view on what the costs are to develop offshore wind projects. And so the profitability is substantially improved and is returning. And we think that in its own right, the movement and direction is positive given the industry's dynamics. We think the combination therefore further positions them for increasing margins of the business. On the right-hand side is a chart that shows the projections of offshore wind capacity. And the industry has gone through radical changes and therefore, again, cyclical business that actually has had a difficult time. Of course, the United States has been part of the compounding problem instead of being very active with plans to develop a lot of offshore wind. That's changed. And so that's been a dramatic reduction in demand. The fact of the matter is the rest of the world continues to grow and it's on a much stable, firmer footer basis. And we think there really is dramatic growth for this business. So well-positioned, excellent competitor that understands the business, that did go through with the teething issues, that's extremely well positioned to benefit from this business also. Coincidentally, the combination of these two companies, the combined revenues of the business actually make this business close to the same size as Halliburton. So it becomes actually one of the big four. We are not in the camp that believes that size makes a better business. However, we think the scope of the business, the combination, the overlap, the integration does make this a better business. And what that may mean for investors is this company is of a scale and size that potentially might attract investor interest. Because today, both of these companies traded a substantial discount to the rest of the industry and specifically to TechnipFMC, even though they're direct competitors to that business. So we think that there's plenty of room for price improvement. And of course, price improvement is a euphemism for substantial stock appreciation. Here's some historical numbers of the combination. As you will note, right, the revenues of Saipem are more than twice that of Subsea 7. That said, Subsea 7's profitability is substantially higher and continues to further improve. So on a profitability basis, they're closer to the 50-50 match at which they've agreed on the terms of the combination. What we also think is the largest piece of the Saipem business is the conventional and surf business that Subsea 7 is in. The competitive combination of the two businesses with the systems for bidding and execution that Subsea 7 has in place, because the subsea management will take over the Saipem fleet, we think gives plenty of room for the opportunity for Saipem itself has been substantially improving the profitability of the business, and there's been margin expansion. And of course, the industry conditions have facilitated that because the high demand and the limited availability means that pricing is different than it historically had been in the depressed times, and margins are expanding and opportunities are growing. So the idea that Saipem's margins continue to improve, we think there's significant upside in addition to the 300 million identified savings. Of course, on an EBIT basis, the combined company has $1 billion of the EBIT, 300 million in cost savings. That's a 30% increase in the profitability just on the cost side alone. And again, we think the real meat here is in the revenue generating capacity and the margin improvement associated with the combined fleets. Governance is of importance. And of course, as I mentioned in the past, that the architect of this whole process has been Christian Siem. And by architect, I really mean that clearly here, this transaction between Saipem and Subsea 7 has been 4, 5, 6 years in the making. the companies have had over the years multiple conversations about potential combinations that could have happened. They did not happen. From Subsea 7's point of view, we think that that's a positive because Saipem definitely had teething issues and therefore did have to do a couple capital raises to therefore shore up the balance sheet, which we has happened, and the results have played out as they make corrective process also to operations, and they've gone through projects that have had issues with them, and so therefore they're in the rear view mirror, we believe. And we also believe that since Subsea 7 did an extensive review between February to July when they just signed the final agreement in terms of due diligence and having a good grasp of course, the offshore business, since many of those projects, if not all of the projects, Subsea 7 was a bidder on, and they've understood the business, the scope of the business, what's involved with the business, and therefore has a commercial understanding that's almost as good as Saipem's as it is. In addition, we pointed out that John Evans will be the president of the Subsea 7 subsidiary, which is the core operating business, which we, is we think the heart of this business. The governance is also important, and we take two things. One is we note that in 2010, when ASUG and Subsea 7 combined, it was a 50-50 deal. The integration of the two businesses, the integration of the board worked relatively seamless. And so therefore he already has under his belt experience in terms of combining with someone of equal size and how do you manage through that combination. So they've got a track record of having done this. And we point that out because it is significant, because the other company we've noted in the process was the merger of Technip, a French company, with FMC, a Texas-based company. And the combination of those two businesses, the governance for a number of years had some rocky issues and caused some concern. And so therefore, making sure that this runs well is important. So here's the timeline, we think, up to the merger completion. The important part is between now and the closing of the transaction sometime in 2026, so maybe a year from now, there's €1 billion of distributions coming to the shareholders of Subsea 7. There are 4 different pockets for that distribution. So the shareholder meeting will be in September, where both companies will approve the merger, we expect and hope. Then in November, the remaining payment of the dividend for the 2025 year, it's actually for the 2024, but in 25, it should be another 175 million euros. It's actually in Norwegian kroner, but that's the estimate for what it is. Then in 2026, there's another distribution each company will make to their respective shareholders. So keeping the relative size and value of the businesses equal, of another $300 million US. Then there's a subsidiary of Subsea 7 that was not part of the combination, and it's in the process of being sold. The profit to be realized is another 105 million euros, which will be distributed when that transaction closes sometime soon after to the shareholders of Subsea 7. And then the agreed terms of the companies weren't quite 50-50. The Subsea 7 was worth something more. And so to equalize that, there's a payment of 750 million euros that will be made at the time of the closing to just the Subsea 7 shareholders to therefore get it to a 50-50 transaction. So that's the transaction. That's where we are. That's the culmination of this period of 40 years that Christian Siem has been the architect. We think of the compelling opportunity, and the opportunity going forward, we think, has substantial improvements for growth, increasing profitability. And this is, not unanalogous to other situations. With that, I'm going to turn it over to David to share some perspective on how we think about it and how we think about it in the context of our business.
Thank you, Bob. And as a reminder, if you have any questions, please use the Q&A feature on Zoom, and we'll try to answer as many questions as we can. But before we turn to questions, I want to zoom out for just a moment. The purpose of this call was to discuss a significant merger of one of our longest and largest investment holdings. But for those of you who are on our 2024 annual call, you may remember I gave a brief overview of another long time and large investment of ours in Builders FirstSource. Now, Builders is a very different business, different industry, different external influences, but both investments began by sifting through cyclical industries, specifically when certain companies, or in many cases, the entire industry, was facing headwinds. and were therefore discounted by other investors who believed that the current state of activity would become the new norm going forward. And that in turn made those industries to those investors, quote unquote, uninvestable. Now, this is a behavioral bias that continues to deter most investors who would rather rely on what they think they know will be true, even when it's often not, instead of investing in situations where there's really a high degree of predictability about the outcome, but the timing of that outcome remains elusive. It's really that uncertainty, though, that's really a critical element of the opportunity. And even more so, the longer that uncertainty continues, the greater the eventual upside can become. Now, in the spirit of Mark Twain's quote that history never repeats itself, but it often rhymes, we think the case for Builder's first source is one that rhymes with the current situation for Subsea 7. In both cases, you have a combination of two of the largest industry competitors, each with different strengths that were at the forefront of their industry's changing landscape. In the case of builders, it was two of the largest distributors of building materials and wood products that today has a $14 billion market cap after buying back roughly 40% of their outstanding shares. And it was the combination that led to a business that generates significant amounts of free cash flow and now has an even larger set of opportunities to both intelligently and opportunistically deploy that capital. I always find it interesting. Most investors would say that one of the best places to hunt for new investment opportunities is where others aren't looking. Yet the same people that would give that answer continue to avoid the places where others aren't looking. And it's this very type of deep research, industry and company knowledge, and awareness of our inherent biases that I hope we've represented in this call. And that's what people have come to expect for Robotti as we do delve into places where others aren't looking. It's been a pillar that has allowed for our continued success since Bob found the business in 1983. And if you'd like to discuss our investment philosophy further, we'd welcome you to contact any of us. It's something we really tremendously enjoy talking about. We want to thank you for taking the time out of your day to join us. And with that, let's turn and see if there's any questions in the queue.
Great. Thank you, David. So our first question is really about the potential risks for this kind of merger. So the question is, what about the cultures of the two businesses and what happens with the merger? Denning's line about culture eating strategy for breakfast. And so I know you touched on this a little bit, Bob, but maybe you want to expand a little bit more about the culture as well as any potential risks for this merger.
So I do think that, as I said, this is the culmination of a dance that's been going on for 5 to 6 years, and so therefore they've had conversations, so they understand at the ownership level kind of how the interest parties align. We do think the structure of the business in that the offshore surf and conventional business is all going to be in the subsidiary of Subsea 7, and John Evans continues to run that. That minimizes disruption because you really do have not a merger of equals in the subsidiary basis, but you have a combination where someone's the person who's going to run the business and the culture that exists and the structures that exist. So and as I've said over the years, the operating people at Subsea 7 and the operating people at Saipem have worked on contracts together. They bid together, they work together, so there already has been an integration. There's a respect between them. So I do think that, again, from a personality point of view, minimizes that issue. At the same time, the businesses of Saipem that Subsea 7 is not in, and that is offshore drilling or the onshore contracting business, are things in which clearly the people from Saipem will run. We think positively also about those businesses from the point of view of a number of years ago, definitely the onshore construction business had many operational issues, that there's really been a substantial scaling back of that business and changing the business. Therefore, much more of the business today is consulting, advisory, contracts, and therefore not fixed price contracts that therefore expose you to the risk. But again, they have operationally changed that business and it continues to execute well. And that's not a function just of Saipem. That's an industry-wide issue that we do see. So Technip Energies, which, is in some of the lines of business, is something that was part of Technip FMC. From a cultural point of view, right, the disagreement between the French and the Texans led to the eventual spinoff of Technip Energies. And so that business now has been right-sized, downsized, and therefore in a position today where it's executing well. And that's not unsimilar to the scale back reduced version that's in CB&I, which is part of McDermott, McDermott is, one of the second tier competitors to Subsea 7. So we've seen that. And then of course the Fluor business again indicates that. So the onshore contracting business has gone through its own radical restructuring, changing. The nature of the business is different. The contracts are different. The exposures, the risks are very different. So, that's, again, that will minimize the risk of something going wrong. And so we think from a structural point of view, and again, as I said, the Subsea 7 and ASUG did merge, and that was an extremely successful combination. And I will also point out that the CEO of the combined company was the CEO of ASUG, the company that was acquired, and not the CEO of Subsea 7. So Christian Siem, has a history of being someone who's doesn't do things based on loyalty and emotion, but really is a critical evaluator of people and making people decisions about it's a meritocracy. So if you're the right person, you get the job. So I think that's also, I think, a positive in terms of minimizing cultural issues, because it's not favoritism, but it's performance that really determines who advances.
Thanks, Bob. A question came in. The question specifically was about an oil spill or drilling accident, but I think I'm going to change it a bit. I think the question is, how important is expertise in this business, operator expertise in this business to what they're doing, and does that form some type of competitive advantage or barrier to entry?
Oh yeah, so let me the best example I can give you. Absolutely, that's what it's all about. It's all about engineering expertise and the depth and the breadth and the knowledge of the people who are at Subsea 7 and Saipem, are really top notch. And that's a critical change in the business. So if you go back 15 years ago, at the oil companies themselves, there was someone who's going to run a project. In the last 10 years, one of the things that's happened is the industry is downsized, and so a lot of the people in-house aren't there because there's been staff reductions, and as a result, the companies themselves need to outsource more. And so therefore, the critical role that Subsea 7 and Technip play in terms of, tell me what you've got, tell me what you've discovered, and I will design the field for you, and I will make sure I will have as much standardization as possible, that I don't build some beautiful palace every time I want to do this with all kinds of inefficiencies into it. I'm going to streamline it. I'm going to do it as inexpensively as possible. I'm going to put all the technologies in it that will facilitate the best project. That is one of the differentiators. So the engineering part is critical, but the proof I have actually most likely is back in 2014. So in 12, there's a company called Siona that was formed. So Siona went out and hired the top executives from Technip, Subsea 7, Allseas, Hermer, and therefore top people went out and built a vessel called the Amazon, which was top class vessel, was the best in class. Goldman Sachs was the capital behind it because Goldman looked at the opportunity and saw the business and said, hey, this is a growing business. We want to be in it. And therefore, the capital came in, shumped their cycle. Things were doing well. The business was doing well. New competitor showed up. They built a brand new ship. They hired the best people in the industry. And then they went out and said, okay, we want to bid on that project for $1 billion. And the oil company said, okay, why don't you show me your portfolio of other $1 billion contracts that you've executed on? Wait, you haven't done any? What are you talking about? I'm not going to give you a contract. Who are you? Don't tell me this, you have this person or that person. You haven't ever executed a contract. The company went out of business without ever getting a contract. So therefore, the barrier to entry was clearly demonstrated with someone who had all the right things, the capital, the people, the vessel, and yet couldn't get a contract because they didn't have the experience. So the experience is a critical differentiator for enabling you to get jobs, win jobs, and therefore, that's as much of an issue as to how can you design the project, and therefore reduce the cost for me in developing this field and save me substantial money, or more importantly, improve my recoveries by 10%. So if you're improving my economics, that there's a dramatic value add, and there are fewer and fewer people who could do that. And it's a combination of assets, technologies, but clearly people of deep experience that is the differentiator there.
Great. Thanks, Bob. So you touched on this a little bit with talking about some of the enabling assets, the asset heavy versus asset light. And so we have a question here that's about the replacement cost. And so could you talk a bit about the replacement cost of Saipan and Subsea 7's assets? And at $19 per share for Subsea 7, what kind of discount does this business trade at for today?
Yeah, it's an interesting question because I have a two-part answer to that, and the answer is it's substantial. So one of the vessels that they built a number of years ago was the Vega, and did they pay 200, 300 million for the Vega? And would it cost to build the Vega like twice that or even more today? So therefore, the replacement cost is high. But I'd actually say again, it's not the assets that are the really the barrier to entry and the profit capability here. It really is the knowledge, the expertise, and the ability to execute on these projects, right? Because that's what I told you before. When you got a great vessel with a great new management and the right backer and all of those things, you didn't get the business. So therefore, it's the utilization of the asset, which is based on technical expertise and knowledge, that really is the differentiator. So therefore, it's not necessarily the asset number. And I do think to replace the fleet would cost more than the current market trading price of the stock. But I do think that that's part of the opportunity because I think the earnings power of the business is substantially larger than it isn't based on what's the assets, and that's the limiting gating factor. It's really the execution capability and the combination of the two fleets, the optimization of those two fleets substantially reduces, as I said, uptime, the amount of work that can be done, that reduces the cost and increases the profitability in a period of time where the demand consumes the full amount of the availability of vessels that are there. And so that's the backdrop of the industry. At the same time, coinciding with this is, very strong in terms of our view as to what the future profitability of this business looks like over the next 3, 4, 5 years. I'll go to another point. And the next point, of course, is okay, so fine, it's peak earnings and then the earnings fall off and all those things. What I actually think is happening is the business is changing. Now, if you listen to Schlumberger, the CEO of Schlumberger talks about the business being much less cyclical. There's changes in the business that I think are fundamental. And there's a lot of reasons for that, including, of course, what we're talking about is a business that has, people talked about, this is a sunset business, that these are stranded assets. I also would point out that there's a change going on in the industry because the projects being developed are discoveries that were made a decade ago or even longer. And therefore, over time, offsets have been identified, costs have been reduced, technologies have facilitated the ability, tiebacks have much. So tieback, of course, is it is a discovery close to an existing field that has infrastructure. So a floating production unit that was designed for 200,000 barrels a day being produced out of the field. Over time, the production has declined. It's now at 100,000 barrels. So the capacity can handle 100,000 barrels extra. Someone discovers 50 kilometers away a smaller field that you could never develop on its own because you couldn't put all that infrastructure in, wouldn't be economic. You can do this long tieback. So technology has facilitated further and further and smaller discoveries to be tied back to existing infrastructure, including recently, Brazil has identified 2 new projects that are the scale and scope and size of a greenfield. So therefore, in Brazil, that's over $1.25 billion is the project cost. But there are really a number of offsetting fields that can be tied back to an existing facility that have kind of there's capacity on available. And yet there's so many of those and when you put it together, it's as large as an opportunity as an existing project. And so more and more things become economic. So the technology continues to improve, which facilitates more discoveries being economic and therefore being developable and therefore more economic opportunity. What also is happening is there's a limiting is to get an FPSO floating production unit to actually put on each one of these locations takes time. There's a backlog. So that's a gating factor that has slowed down what otherwise this industry probably would have been booming today and probably would have been twice the activity and potentially the same thing that happened in 12 and 13 and 14 where inefficiencies in supplying these things and getting them done on time and therefore cost overruns. Instead, the gating factor of consolidation that's happened, the suppliers, the service companies, the producers of and the manufacturers of the floating production unit are limiting what can be done. So that therefore there are certain projects that that's what you do. You break the project up into smaller components, phase 1, phase 2, phase 3, and you then scale it out. So a project, there's a very large project off the eastern coast of Canada called Bay du Nord. That's probably a project that probably will end up being developed over a 10-year time because you've broken it into small pieces. And by doing that, therefore, that fills the level of activity and makes it less volatile and therefore more sustainable. So we think that in addition to the large backlog, the increasing amount of awards, we also think that that stretches out the delivery time and therefore moderates the volatility the industry has historically seen because there's a limited number of people who are in the FPSO business, who are in the equipment business, who are doing the installation. And therefore, they're not rushing to run and to overcommit. Instead, they're managing that process intelligently, and that moderates the volatility in the business.
Thank you. So we have another question about some potential risks for this merger. And it's specifically, how do you view capital allocation risk given a group CEO that's coming from the Saipem side of things? And is that any potential risk?
No, because we don't, that'll be a decision at the board level. We don't think that, Saipem, first off, has gotten religion over the last number of years, right? They're not the crazy people they once were. And, having a couple of near-death experiences tends to do that. If you make it through, it changes your thought process and how you think about business. So on its own, I would suggest that Saipem had already made substantial corrective actions, and therefore, that includes management and a more thoughtful process in terms of the economics. So therefore, that we think that substantially mitigates the risk that there's someone who goes crazy in this business. So we don't really think that there's a capital allocation problem because that's going to really be done at the board level, and Christian Siem's going to be involved with that process extensively, and therefore moderating any risk. And then, of course, even at the operating level, John Evans isn't going to recommend building a new vessel when it doesn't make any sense to do that. So I think that that's not really risk. What I will say is there is a risk in combinations, right? Historically, if you do look back, in 2000, 2001, we were shareholders in Stolt Offshore, which had a near-death experience. The near-death experience was it acquired a company called ETPM, a French company that had a contract in Africa that they ended up losing $200 million on the contract. Therefore, of course, all kinds of issues. Stolt Offshore had to go through a substantial restructuring. They brought in all new management. They hired the CEO who was at Technip at the time. They raised new capital to restructure it. They worked through the contract. They completed it and got it done. So that contract almost bankrupted the company. I'll also point out that on the combination of Subsea 7 and Acergy, right, not long after that, one of the contracts that Subsea 7 had bid on and won was its first contract where they did a fixed price contract. Historically, most of their assets ran on a day rate basis, more like offshore drilling rigs run, and so therefore relatively limited risk. And not contract risk because you got the wrong price because you bid a lump sum contract. Here they did the lump sum contract. That was at a time when the industry structure was such that deliveries were late, things were delayed. The plant originally where it was going to be built and constructed onshore Brazil couldn't be executed on because the local governor wouldn't approve the location. So it added cost to the process. And they ended up on Guarulhos, the combined company, losing $300 million. Of course, reality, a lot of the money they lost in that contract, a good portion of it was actually recouped through work order changes, and eventually Petrobras paid the money, but it was over time and caused an issue. Now, that same thing could be happen. There's a lot of contracts here. It's one of those contracts on a fixed price basis. We think there's less risk given where we are in the cycle, what the pricing is in the cycle, the discipline that each company has. But if it does have it, what we also point out is the scope and scale and size of the combined company is that if you have a $200-300 million loss on a contract, it's it hurts, but that's not a life-threatening thing. So again, that mitigates the problem that if something were to develop, then there is a contract that's going to be anything that's going to be clearly won't be life-threatening, but more importantly, it'll be an inconvenience for a quarter or two, and that's really about it. We don't expect that to happen. We do think that they've, again, the structure, the process, the management reduces those risks, but things can happen.
Thanks. Bob, there's a question about the sensitivity of the business to oil prices. The question mentions specifically an event such as if the Russian oil embargo is lifted. And what other factors actually drive the business, drive revenue?
So as I noted, of course, Saipem in a number of their slides that do go through this and say of the contract backlog, 40% of the contract backlog is in natural gas. And so 40% of the backlog is oil. Now, they have the onshore business that weights a little more to natural gas. But a significant portion of the projects offshore are natural gas. Now, there are two natural gas markets, right? There is the floating LNG market, which does tie into oil prices. However, it is a different market, right? Because therefore, what you really do have on floating LNG is you're probably entering into an offtake agreement with probably a buyer in Asia for a 20-year period of time. So therefore, it is less subject to I drill a well, I complete a well, and in 3 years' time, I start to produce a well, and oil price has gone down, and I have a lower oil price. When you start the project, you're contracting in pricing that gives you more certainty and less volatility and less risk on the commodity price and when it's done. So therefore mitigates that risk. The second natural gas market is not the LNG market. And the LNG market is Mauritania. So BP had a discovery a number of years ago. It's called Tortue, which they finally completed and developed because they took them forever to do it. It cost them much more than they wanted to because instead of hiring Subsea 7 and paying 10% more, instead of paying a little bit more than they wanted to, they paid a little less than they should have. And instead, McDermott screwed the project up because they tried to use the Amazon, which they had upgraded, but it really didn't function. And therefore, they had cost overruns and there's litigation between BP and them and delayed that whole project. But that's a long-winded digression into the McDermott and BP and integrated awards. But what that Mauritania is not going to consume the natural gas that was covered in that field, but the LNG market is where that went to. So same thing, Mozambique is there's a number of projects there that had a start, had a stop, probably are starting up again. And again, that's LNG market. And so that does generally somewhat tie into oil, but again, it's a different dynamic in terms of the pricing on LNG offtake agreements than it is on oil, which is subject to oil markets and the volatility. The other market is, as I said, Turkey. So 3-4 years ago, Turkey made a discovery in the Black Sea. They fast-tracked that. They were able to fast-track that because Schlumberger, the Subsea Alliance, working together with Subsea 7, could develop that field in really record time. And therefore, in not bringing in the Turkish National Oil Company managing that process, they were able to fast-track that project. And that project now supplies close to a third of the natural gas in Turkey. So Turkey is going to go ahead with that project if oil price goes to zero again. Because what it does is they're buying natural gas from Russia or someone else. And so the domestic market being supplied by that offshore discovery displaces the purchase and gives energy security, right? Energy security is not a word I use this entire time, but given Russia's invasion of Ukraine is something that is in the minds of people not only is it the right price, do I have dependable energy sources that I can rely on and therefore run my economy and run my country? And so therefore, that self-sufficiency is critical. You see the same thing in the Eastern Med. So whether that's in Egypt, whether that's Israel, whether that's Cyprus, there's a number of projects there that are all for local domestic markets. Those projects go ahead without regard to where the price of oil goes. So there's less of a concern about oil price. And the other thing that you did, I'll interject in there that you did say, well, what happens if there's a peace and Russia starts to, therefore, is not being banned? Russia won't produce a barrel more of oil. Russia produces all the oil it possibly can produce. I would imagine that there's some risk that they're overproducing, that they're depleting, they're permanently damaging the reservoirs that are producing because their intent is to get as much money as they can because they're selling it at a discount. And so therefore, there's no reduction, there's no capacity for Russia, I think, to produce much more than it does. So it is already selling every barrel it possibly had. And intuitively, that makes sense because they're getting 20, 30% less for it. So how do you make it up? You make it up on volume. So they're selling everything. So the likelihood that there's peace with Russia doesn't change, I think, the supply of oil in the world. And so I don't think that that's a critical element at all in the equation.
Thanks. So we're coming up on an hour here, so I'm going to combine a couple questions here and give you just one last one before we wrap up. And so this is from two different people, but what's the possibility of the transaction not being approved by shareholders? And after the merger goes through, do you think there's going to be any change in how the company approaches whether it's dividends or share buybacks?
Uh, I think that's a very low risk, right? So there's two substantial shareholders in the case of Saipem, and that is ENI, the Italian national oil company, right? Energia Nazionale Italiana. And so therefore they control the company, they're in favor of it. And the other one is the Italian government, a branch of the Italian government. And so they are going to be members of the board. And so therefore they've given commitments to vote in favor of it. So the Saipem side of it, I think, is actually less risk because you've got two substantial shareholders voting in favor of the transaction. The same thing's true of Subsea 7. You have Christian Siem owns 25% of the company through Siem Industries, and so clearly they're going to vote in favor of the deal. I'm going to vote in favor of the deal. I would recommend that everybody votes in favor of the deal. I think it's a great transaction for the combination of the two businesses. So the likelihood of it not being approved by the shareholders is remote. Now, the concern really is not the shareholder approval, but it really is the regulatory authorities in each of the jurisdictions, and is there concern on an antitrust basis in terms of the combination, right? You do have the number one and number two company, or the number two, 1 and 3 company, at two of the top 3 companies combining. Is there an antitrust issue? So in certain jurisdictions there is no antitrust provision. In places where there are, such as the North Sea, whether that's Norway, whether that's the UK, the participation of Saipem is relatively limited, and therefore they're not a large participant, so it shouldn't be much of an overlap. Same thing in the Gulf of Mexico. There's really no participation on the part of Saipem, so therefore that's really not a gating factor. So there are very few jurisdictions that have antitrust concerns that there really is an overlap between the business. The one place that is a concern is Brazil, because it is a key critical market, and right, it is one of the most important offshore markets. Subsea 7 is the substantial, if not the largest competitor in the Brazilian market. Brazil and Petrobras continue to aggressively develop the reserves. And again, you asked the question on oil price and volatility. Petrobras's capability and interest in developing those fields is substantial for many different reasons, including the governmental geopolitical kind of issues. And so activity goes ahead. So they would there have been contracts in which there has been only one bidder, or they haven't been able to get a second bidder. So they are concerned with the dearth of people offering. And that's not just in offshore completions in terms of the field delivery, that Subsea 7 surf business. The same is true for the OSV business. They're looking for more OSVs because there's more activity and there's a limited number of boats. And so across the board, Petrobras is concerned about service availability and would like more. And so therefore, they would love Saipem to be a bidder. Of course, they had sanctioned Saipem because Saipem 10 years ago was involved with the scandal in Brazil of payments by providers to people at Petrobras, including people in the government, including the current president, who was indicted and convicted associated with money laundering, in that situation, and had been penalized and couldn't bid on contracts. They recently waived that restriction and said, no, okay, we're hurting ourselves by restricting you and penalizing you. We want you to bid. And so there is some concern that Brazil is concerned about, does this reduce the amount of competition that we have? And therefore, it's not the competition so much, even it is really people being able to execute the work that we see in front of us that we need, therefore, equipment for. There is a template, right? The combination of Aker Solutions equipment business and Schlumberger's business agreed to in 22, completed in 23, went through the same regulatory authority. It was the number 2 and the number 3 competitor in a marketplace that was top 3 guys at 85% plus of the market combining. So there's a template for a similar transaction in a similar space with similar players being approved by the regulatory authorities there. So therefore, some basis that, there would make some sense that there could be an approval here. The geographic spread of the assets and where they are and how they work, and the ability to, Brazil has made it known they would like an extra relay vessel. And so therefore, how do they get a relay vessel to come into the market? How can Subsea 7 take advantage of Saipem's fleet, work out the 2 of them, and therefore get availability on a piece of equipment that they can bring to the Brazilian market, and of course, deliver what Petrobras wants, and in the process being able to provide more service to them in the form more revenues from them and more profitability from them. So I think there's a win-win that also Subsea 7's combination with Saipem will facilitate them providing the solution that I think Petrobras in Brazil really needs and would like as part of a combined business is a more capable in terms of being able to provide the service you want.
All right. Thank you, Bob. And thank you everyone for joining the call today. If you have any follow-up questions, feel free to reach out to us. But yeah, thanks for spending the time with us, and I hope you learned a little something.
Thank you. Appreciate your coming and appreciate your interest. Take care. Good rest of the summer.
Thank you.